Chapter 19 of The Intelligent Investor, titled Shareholders and Management's Dividend Policy, dives into the critical relationship between shareholders and company management, with a specific focus on dividend policies. Benjamin Graham, through this chapter, provides a thorough examination of how dividends impact both investors and corporate governance. His insights into dividend policy are crucial for investors seeking to understand whether a company's approach to profit distribution reflects strong financial health and prudent management. Understanding dividend policies. Dividend policies are central to the relationship between shareholders and management. Dividends represent a direct way of returning profits to shareholders, allowing them to share in the company's success. Graham begins the chapter by outlining the traditional role of dividends in corporate finance. Companies generate profits, and a portion of these profits are paid out to shareholders in the form of dividends. The decision on whether and how much to distribute to shareholders, however, is entirely at the discretion of the company's management. According to Graham, a reasonable and consistent dividend policy is a hallmark of sound management. Dividends are a way for shareholders to see tangible returns on their investments, and a company that maintains a stable or growing dividend payout is often viewed as being in strong financial health. Graham stresses that the reliability of dividends should be a significant factor in determining the investment worthiness of a company. The balance between retained earnings and dividends. A key part of Graham's argument is the balance between retained earnings and dividends. Retained earnings refer to profits that are not distributed as dividends, but are instead reinvested back into the company. Management often justifies retaining earnings by claiming that the funds will be used for expansion, acquisitions, or other investments that will eventually increase the company's profitability. However, Graham urges caution when evaluating such claims. Management's decision to retain earnings rather than distribute them as dividends may not always be in the best interest of shareholders. Graham is skeptical of companies that withhold large portions of their earnings from shareholders, particularly when these funds are used for questionable purposes such as excessive expansion or speculative ventures. He warns that overconfidence in management's ability to reinvest earnings effectively can lead to poor allocation of capital and ultimately harm shareholders. Graham acknowledges that there are legitimate reasons for retaining earnings, especially in companies with profitable growth opportunities. However, he stresses the importance of transparency and prudence. Management should clearly communicate its intentions to shareholders and demonstrate a track record of successful reinvestment. If a company cannot reinvest its retained earnings at a higher rate of return than shareholders could achieve through alternative investments, Graham argues that those funds should be returned to shareholders in the form of dividends. The importance of consistent dividends. Graham is a strong proponent of consistent dividends. For him, a company that has a long history of paying regular dividends sends a message of stability and financial discipline. Shareholders should favor companies that maintain a stable or steadily growing dividend, as this is often a sign of strong management and careful stewardship of the company's resources. Companies that regularly pay dividends are also seen as more shareholder-friendly. Graham emphasizes that the dividend payout ratio, the proportion of earnings paid out as dividends, should be a key metric for investors. A higher payout ratio indicates that the company is more committed to returning profits to shareholders, while a lower ratio might suggest that management prefers to retain earnings, potentially for less profitable purposes. In particular, Graham is critical of companies that cut or suspend dividends without a clear reason. He argues that inconsistent dividends are a red flag for investors, as they may indicate underlying financial problems or poor management decisions. A company that reduces its dividend may be experiencing declining profitability, liquidity issues, or excessive debt, factors that could lead to long-term declines in its stock price. One of the central themes of this chapter is the role of management in setting dividend policy. Graham underscores the idea that management should act as stewards of shareholder value, ensuring that profits are either returned to shareholders or reinvested in ways that will ultimately benefit them. He critiques management teams that fail to distribute adequate dividends, often due to overconfidence in their ability to reinvest earnings more effectively than shareholders can. Graham argues that some management teams retain earnings because they are focused on empire building, expanding the company for the sake of growth rather than focusing on profitability and shareholder returns. In such cases, shareholders should be wary of companies that are overly aggressive in their expansion efforts but offer little in the way of dividend payments. In contrast, Graham praises companies that treat shareholders fairly and distribute a reasonable portion of their earnings. Management should take a balanced approach, distributing enough dividends to reward shareholders while retaining enough earnings to support future growth and ensure the company's long-term stability. Dividends as a signal of financial health. For Graham, dividends are more than just a way for shareholders to receive a portion of profits. They also serve as a signal of financial health. A company that pays regular dividends, particularly in times of economic uncertainty, is sending a strong message that its earnings are stable and that management is confident in its financial position. Conversely, companies that cut or eliminate dividends may be signaling financial distress. A reduction in dividends can often be a precursor to declining earnings or financial instability, and Graham urges investors to view such moves with caution. When a company reduces its dividend, it is effectively admitting that it cannot generate enough cash flow to support its previous payout level, which could indicate deeper problems. Additionally, Graham suggests that rising dividends over time are a positive sign for investors. A company that can steadily increase its dividend demonstrates its ability to generate growing profits and its commitment to returning value to shareholders. This is particularly important for defensive investors who are looking for safe, income-generating investments. An important aspect of Graham's discussion in this chapter is the role of shareholder advocacy. He believes that shareholders should be active participants in corporate governance, using their voting power to influence management decisions. Shareholders should hold management accountable for its dividend policies and other financial decisions, ensuring that the company's resources are being used in a way that maximizes shareholder value. Graham encourages shareholders to vote against management if they believe that dividend policies or other financial decisions are not in their best interest. While shareholders may not always have the ability to directly influence management, their collective power can send a message to the board of directors and management team. This aspect of shareholder activism is particularly important when management is perceived as being self-serving or focused on objectives that do not align with shareholder interests. For example, if a company is retaining excessive earnings without clear plans for reinvestment or dividend distribution, shareholders should raise concerns about whether those retained earnings are being used effectively. Graham reserves some of his strongest criticism for companies with poor or inconsistent dividend policies. He highlights that many companies, particularly during times of economic growth, become overconfident in their ability to reinvest retained earnings. This overconfidence often leads to speculative investments or unwise acquisitions, which ultimately hurt shareholders when the company fails to generate the expected returns. Additionally, Graham warns investors to be wary of companies that consistently fail to meet dividend expectations. He believes that management's failure to return adequate profits to shareholders is often a sign of underlying financial difficulties or mismanagement. Investors should be skeptical of companies that have a history of cutting dividends or failing to maintain a reasonable payout ratio, as this could indicate broader problems with the company's financial health. In Chapter 19 of The Intelligent Investor, Benjamin Graham provides a thoughtful analysis of dividend policy and its implications for both shareholders and management. He emphasizes the importance of consistent, reliable dividends as a sign of strong financial health and prudent management. For Graham, dividends are more than just a way to distribute profits. They are a signal of management's commitment to creating value for shareholders. Graham advises investors to carefully evaluate a company's dividend policy when making investment decisions. Companies with stable, consistent dividends are often better managed and financially stronger than those that cut or eliminate dividends. Investors should also be cautious of companies that retain excessive earnings without a clear, profitable plan for reinvestment. Ultimately, Graham views dividend policy as a reflection of management quality. Companies that prioritize shareholder value through regular dividend payments are more likely to be well managed and financially stable, making them more attractive investments for the intelligent investor. By focusing on companies with strong, consistent dividend policies, investors can increase their chances of achieving long-term financial success.
Thank you for watching. Share this with friends and family, and please subscribe.